Hey, it's Richard with Matthews Wealth Management. We are doing our end of the year 2020 market update. We made it. We made it through 2020. Thank goodness. So we're going to talk about the December performance, the quarterly performance, and then just the full year to date. This is pretty number specific. I do want to do a little bit of additional information above and beyond our normal market update in this episode, or this whatever we want to call these, but let's just jump right in and see what we got. In this last month of December, pretty much everything was up. The only red that we see here is long-term bonds. So let's talk about kind of what we see here, and you'll notice some trends as we move on and talk about, overarching lessons that we got. So from large cap value, core, and growth, we've got the 3.5, 5, let's just say 2.5 there. So what we're noticing is that there is this big shift away from growth, and that's different, that's good, that's how things should be. It's also showing people are starting to pay attention and pick up on some things. So if we go to mid caps, we've got the 3.25, 4.25, and then 5. Oh, that's a little different, right? That's opposite of what I just said about the large cap side of it. And these are bigger numbers in general. We're starting to see that the growth going up is outpacing the value. That's typical of when we start seeing money moving into the market. So people kind of started moving some cash back in. Small caps took off. They're kind of an irregular shape here, but 7, 6, and almost 10. And this is 1 month, right? Just the month of December. So that's big. That's a lot of gains in small caps. So if you recall, back to December, it's January now, we're getting back into the economy starting back up. We've got Pfizer, Moderna, all these vaccines. The election's over. We're starting to sense some stability and maybe some momentum to picking things back up, getting back to work. There are also some spikes, right, with COVID and so forth. So it's a little bit risky, but obviously small caps, the risk is paying off, at least for the month of December. International and emerging markets are normal. That's the right relationship and ratio we would expect, that we would have the 4 2/3 and a 7.5 there. Those are big numbers though, right? So there's a lot of gains that we're seeing. These, just in general, in equities, big numbers for 1 month. Now we get into bonds. Bonds are pretty much flat, except for tips, right? So Treasury inflation protected securities are up 1.15. We're flat on short terms, intermediate, and down on long terms. We see high yield is doing what it's doing, right? It's up 1.88 in the month. High yield has been great this year. It's been normal. It's been average, what it's supposed to be. But tips, that's through the roof, right? 1% per year or per month. Extrapolate that throughout the year, that's over 12%. So keep your eye on that one. Real estate is starting to try to come back and recover, 2.76 on the month, 6.5 between the two commodity classes that we track. And then Dow Jones, we've got the S&P at 3.84. The Dow Jones moderate, what I wanted to point out here is it's basically keeping up, right? So a Dow Jones moderate, what we would try to track compared to it is a 50-50-ish portfolio. There's still some real estate, cash, commodities in there, but more or less we're going to have an even mix between stocks and bonds. And we just talked about some big numbers up here, the 7s, the 5s, the 3s, 4s, and then zeros down here, and even a negative. But somehow it's basically keeping up with the S&P 500. That's not typical. That's not common. So let's fast forward, or actually reverse, to the 3 months, the previous quarter. So we're going October, November, December now. We've got large cap value at the 14, right? 14, 11, 8. That's flipped completely from what we've been seeing throughout the year. And now people are starting to pick up on the large cap value. Also, we can look at the mid cap, and we've got the 20, 17, 19. That's basically flat. They're all the same. Huge numbers, right? On a quarterly basis, you multiply that by 4. I mean, this is an insane amount of money that's growing here, out of thin air. Then you have small cap value at 33, 26, 28 on the core and the growth. So also astronomical numbers there. And you see the majority of it is going into the value side. So We'll talk a little bit once we get to the year to date as to kind of what the relationships are and what we're seeing happening. But that is just crazy to see what the last quarter of 2020 brought us in terms of investment performance in the U.S. equities. Going into international, we've got the 16 and 19.7. That's normal. That's what we want to see, is that emerging markets are higher than international. Again, these are very large numbers that we would see on a quarterly basis. Tips 1.62. It's kind of the same that you're seeing there on that 1 month. Kind of flat also compared to the short-term and intermediate on the 1 month. And hey, at least long-term bonds are positive here, but still we're seeing just big old double digits and then nothing down in the bond area. High yield bonds is a little opposite. 6.5% in 3 months is great on a high yield, and that's what we would expect-ish kind of in this environment. Maybe a little high, but real estate 8.7, just on full recovery mode, getting real estate sold. And a lot of that has to do not just with like houses and residential and flipping, but with office space and storage, and there's a lot of debt on real estate that people invest in. Gold dug itself back out of the hole. If you remember in November, I believe it was a -10 that we were seeing there. So that helped pull it back out. So we're almost back to zero. In fact, that's our only negative for the quarter. Oil had a big quarter, 18%. Again, digging out of a big hole from COVID crash. But S&P 12 and Dow Jones moderate 11. Again, that's amazing to see a moderate portfolio keep up with the S&P 500 with flat bonds, right? So it just goes to show really what is the S&P 500 made of, and it's not a ton of growth. So it's a good little lesson that 50-50 isn't always gonna really underperform a full-on aggressive, stock S&P fund. So year to date is, let's see, I've been doing this 15 years. I've never seen anything like this, but it's been interesting, and this tells the whole story. So if you were the normal investor that is investing for retirement, you want some dividends, you want the safety, you lost money in the large cap value. That would be like Coca-Cola or Lowe's, IBM, GE, that kind of stuff. But you didn't do so good if you were a value type investor. On the flip side of it, if you liked Tesla or Amazon or Alphabet, eBay, you made 40%. That's crazy. Also in mid caps, you lost money if you were on the value side. You made 46 on the growth side. So it's just night and day, absolute opposites, depending on the type of investment that you chose, right? Whether it was value or growth. Small caps, we'll see 16, 43. So you've got this 38, 46, 43 as these year-to-date numbers in the equity classes in the US, and they're all in the growth side. So it should be raising some flags right now. There's something up about that. So international and emerging, the right relationship. Emerging is a little high, honestly. If you've got an 8 and an 18, you'd expect like an 8 and a 12. But at least it's not inverted like we were seeing probably from August until October. We were seeing some very strange relationships there. Those have sorted themselves out, maybe gone a little too far. Treasury inflation protected securities at 11% for the year. The key here is I stands for inflation, and we'll talk a little bit about that for the end of this here. Then we get to the short terms, 3, 6, that's very normal, that's good, that's what we would expect. 16 is super high for long-term bonds year to date, and really where that comes from is the COVID crash, and I keep saying that, that's I guess what I'm coining it, but back in February and March, we saw the market bottom out. A lot of people ran into long-term bonds. They saw interest rates were going to plummet. Part of stimulus, we lower rates, we make it easy to get money, to borrow money, to invest money, and people want to get the interest while they can, while being afraid of the equities, and hence that's why that is such a high number. That number used to be much, much higher. It's actually kind of been coming down as we've dropped off some of the previous months there, but high yield had a 7% year. Great, that's what we would expect. If you had asked me in January of 2020, what are we looking at on high yield? Anywhere from 5 to 7 is kind of normal. It played right where it should. Real estate still down 420. Real estate had a really rough go during the COVID part, and honestly, I believe a lot of this is yet to come. I mean, there's postponing of evictions and mortgages and all of that stuff got kind of pushed down the road. So we'll see whether this drops back off to where it was before, because people expected it. And then we just kind of rewrote the rules on a lot of these loans and leases and so forth. So we'll see what happens in real estate. Gold was up 21%, right? So when people were afraid of the equities, they run to bonds, they go to cash, or they go to gold. Gold is also kind of an inflationary commodity. It's not a consumable like oil. So to see a 21 there is kind of foreshadowing. Oil having the negative 60, that's better than the negative 80 or the 79 that we saw back in, I think that was the March or maybe even April market update. You can go back and check all of them if you want, but back up to negative 60, yay, we'll take it, right? Going forward though, we're starting to see some momentum, the 18 and the 6.5, and I think a lot of that just has to do with this idea that we're gonna restart the economy. We're gonna get back to work and producing things, goods and services. So overall for the year, the S&P 500 up 18.4%. Dow Jones moderate 12.24. That's getting there, right? Normally you'd expect that to be maybe 9 or 10, right? About half of it. You're doing 50-50, and these are just huge numbers, but it's just been a weird year, right? So, but this is more normal than what we're seeing here, right? These are keeping up with the S&P. This is what we would kind of expect on a year where the S&P goes up 18%. So let's talk about Matthews Wealth Management, and then we'll look at the big picture here for 2020. The best short term, just to kind of give you the background on short term, a lot of cash came in at the bottom of the February, March, and as we invested that to try to take advantage of the cheap prices and so forth, we call that short term in the year 2020. I'll do away with that in 2021, but the best long term would have been a client that I've been managing for a year plus, 2 years, 10 years, whatever it is. So it's kind of funny because the short terms were through the roof, let's say August, and now they're flipping in December to where the long terms are actually outperforming our short terms. So you start to see a lot of the bubbles bursting, if you will, out of the short term. So still 36% is a good year. 41 is a better year. The worst account we had lost about 10%. That's not great, but it's part of the game, right? If I'm looking at just these numbers evaluating an investment company, like if I wanted to buy another company and I saw this, I'm saying, all right, well, a negative 10 versus a positive 40, average it out, great. That's not terrible. Overall average is 10.7. And obviously when I look at this, we did this again in November, I come back and say, all right, overall, we're actually taking probably less overall risk exposure than moderate, but as far as performance, we typically see moderate performance. The 12.24 versus the 10.7, I'm not super thrilled. I wish we had more than the 12.24, but I'm going through and saying, well, why? I need to understand why all this happens. We moved a bunch of money into cash as kind of a defensive move. So we're sitting on a lot of cash, which is good and bad, and I'll kind of hint at that here in a little bit, but moving to cash is also opportunistic down the road, right? So cash is an investment of itself. People say, oh, well, the market's up, are you gonna sell? Well, there's a flip side of that question. What are you gonna buy, right? If you're selling Tesla and you're just putting it into a money market, you're buying cash, right? So is it the right time to buy cash? So we're making that decision, and I believe that's where the gist of we were outperforming the moderate pretty much all of the year. Now we're behind, it's the cash, right? So that's kind of why I'm looking at it that way. All right, let's talk bigger picture. I've never done these in a market update, and I think I'm gonna do a few more educational videos on what I'm about to talk about, but for the end of the year, we kind of can see a better snapshot of what happened to generate this craziness, right? All these numbers over here, especially the year-to-date column. So what I want to do is say it's the end of the year. Where were we in January, or the closest number that I can find with statistical data, and then compare that and say what's happening behind the scenes to generate a -3 and a +56. All right, that's the biggest spread we've got. So first things first, GDP, gross domestic product, right? So we're measuring the economy. What is the economy? Such a basic question that not many people can answer, right? So just think of this in terms of, out of all the people in the US, what is it that we are buying and selling and exchanging in goods and services to make each other's lives better, right? So we are at 21 trillion 170 billion 300 million, and I'm sure there are other numbers there, but we round, I guess, at that point. That is how much exchange we have with each other in the US. So how does that compare to 2019? We're down about 8.5%. Well, we had COVID and we shut everything down, and it's just the way it is. And I personally had COVID in December. It was terrible. It really was rough on me for whatever reason. I have that bad immune system that doesn't get along with it. But it's a real thing, and it really shut down our economy by 8.5%. So what does that mean? Well, if we continue doing that, our standard of living drops 8.5%, right? As far as what we can buy or go out to eat, or just the everyday things, there's that much less of it going around. Okay, so that's logical, right? We experience that, we understand that, but how does that play into the big picture is what I kind of want to allude to here with the next two. So this is probably my biggest pet peeve, and I should do a separate video for it, so I'll try to consolidate this so I don't get long-winded here. Money supply, and I'm specifically talking about the M2 money supply. When they rate M1, M2, and so forth, it's the types of accounts and the money that they're measuring here. But we have 19 trillion 86 billion dollars in M2 circulation, right? Like, how many dollars are out there? So if we have 300 million citizens and each person has $1, all right, well, we have $300 million in our money supply, right? Very basic, very simple concept there. But if we grow our money supply, let's say we've got 300 million citizens and we're gonna have $600 million. Everybody's now got $2. Does that change how many goods and services that we're exchanging? Nope, it just devalues each dollar in half, right? So that's the concept. That's what we're dealing with. Money supply, if you ask me, if I could make decisions, should always be the same. Why would we change it, right? We changed that back in 1971, I believe. Nixon got us off the gold standard, and then we just went crazy printing money, right? This is the definition of printing money. We print digitally now, where we just move money around and it shows up in these accounts. But in 2020, we gained 24.7% on our money supply. That's the biggest thing. Like, that is just moved the goalposts completely. Like, that's tremendous. If we do 3%, right, inflation, great. But 24.7, okay, how are we supposed to measure anything now, right? And that's ultimately why we get this. Like, what in the world is valuable? We don't know, because all of this money came in. Where did it go? Well, I think it went here and here and here and here. What was that? Oh, okay, S&P's an average. So yeah, there's a lot of money that came in. Where did it come from? Well, it didn't come from the economy. It came from digital printing, right? So now let's talk about central bank balance sheet. If you remember the housing crisis back in 2008, 2007 and 8, and then we worked on it with that TARP, the bailout, the Troubled Asset Relief Plan or program. Not sure what that P is, but that was where we gave a bunch of money to banks, right? And it kind of all flowed through. It actually started with Treasury, then it went through the central banks, and then it got out to all the surviving banks and consolidated that industry. But anyway, the central banks, the Federal Reserve, they bought a lot of these bad mortgages and a lot of these bad CMOs and CDOs. Those are debts and so forth. So when they do that, it goes on a balance sheet, and then they have to do something with it. They either sell it later, or they can print some money for it and then just kind of float it back out there. It gets weird in the world of just finance and how they run things. But from January to December, now they're sitting on $7,252,103,000,000 on their balance sheet. Well, you compare that back to January, they grew their balance sheet by 75.8%. So where did that come from? And if you go back, you can find out exactly where it came from. A lot of it came from this high yield bonds, right? It had a very good average year. But what they were doing is buying these bonds that were actually downgraded. They used to be investment grade bonds, and they were regrading them. S&P, Moody's, and Fitch, they kind of grade bonds and investments and so forth for risk and security. They took a lot of really good bonds, called them high yield, and then here comes the Federal Reserve, and they bought them, right? And they just kind of put them on their balance sheet, and that helps prop all of this stuff up, right? So this creates extra money to come out here. This money funneling through here comes up here. Meanwhile, the economic engine's stalled, right? So here's what I'm saying is that we've got some bubbles, right? These bubbles are created artificially by printing some money, and these bubbles pop once people look for what they want out of an investment. And the best example I can give of that would be like value, right? Large cap value. People buy that like Duke Energy or Lowe's or whatever. They want a dividend, right? They want a yield. They want to live off the income of their investments. They don't want to have to sell their investments to go buy a hamburger or something, right? So as soon as we start looking at, is there a dividend, or is this a way I can live with higher inflation and Treasury inflation protected, right? So this adds up, this makes sense. As soon as I ask myself, can I live on this income, I might have to make some changes, right? So ultimately, we've got an issue where at some point in 2021, we're going to have to look at a balance sheet and a income statement and say, there's not enough revenue, or there's not enough earnings, or there's not enough capital in this business to justify a price, right? And which one it is remains to be seen, but at some point we're going to care about the fundamentals of a business, right? And whether it's kicking off a profit to me as an investor, or if it's not, maybe the price doesn't make sense and I'm going to go find something else that is paying that dividend. So I think maybe the end of the first quarter, we'll look at those quarterly reports and say, oh, this is odd. And you may get a big reshuffle. But there's also the Georgia runoff, where we're talking about politics, stimulus money, Green New Deal, extra spending, more money supply, more balance sheet. It might add to GDP, it might subtract from GDP, but all these things could shift substantially depending on what happens with the outcome. You've got a Democratic president, Democratic House. If you get a Democratic Senate, that usually means a lot of this doesn't go well. So not to be political, I'm not trying to be political, I'm trying to just inform you what actually causes this. So in 2021, we've moved a lot into cash. We are expecting a correction in the equities market. We're looking for bonds constantly that are paying decent interest. There aren't many. High yields are good because there's always demand over here, but there's inherent risk in high yield too, so you got to know what you're buying. We're going to make some changes this year for sure, but 2020 was wild, and that'll be one for the books. I'll keep coming back to this video for years just to kind of see what these numbers were. So hopefully this was helpful. If you have any questions, if you want to talk about this stuff, give us a call, reach out to us. We're here to help. Hopefully this was helpful. 2020 is over. Thank goodness it's 2021. Let's go on and see what we got. Y'all take care. We'll see you next time.